question mark. So let me throw some light, which may not answer every question, but at least it will give you directionally, how multiples get re-rated. Because once you understand the dynamics of that, you can take a much educated call on valuation.
Samit, first of all, thank you so much for accepting our request and taking the time out from your busy schedule. I know you've been occupied in terms of tracking the numbers of the companies and the quarterly results, etc. But somehow I could manage to get 30 minutes of yours from your busy schedule. So thank you once again.
No, really appreciate you inviting me. You are organizing such a beautiful conclave. Some of the best minds in the industry. So always looking forward.
Right. Thank you. So the whole idea is to basically educate and empower the investor community as a whole, because at times, as Ashish was saying before you joined the session, is that they carry some perception because they read the newspapers and start thinking in those lines. It's very important that we come together and discuss openly what is there in our mind, which can help the investor community to take the right decision. So let me have the privilege of introducing Samit. So he's the founder and CIO of SageOne Investment Manager. So SageOne Investment Manager LLP has been into existence for many years now. Samit has been investing in equity since 1999 and has experienced and studied many bull and bear cycles over the last 2 decades. He has worked closely with various companies, company management in the US and India, advising them on business strategy, profit optimization, growth, and valuations. This experience forms the backbone that he helps him better understand the business and their fair value. Well, I would say that, if I have to introduce Samit in simple line, that, I personally admire him a lot for his valuable wisdom, because he's a voracious leader, understands the dynamics of the markets very well. And I've seen many ups and downs of the markets, but Samit would definitely would have his own thought process on each of the companies that Samit and his team would buy into, the rationale behind it. So he, SageOne Investment Manager, as an organization, they manage HNIs and ultra HNIs funds and have been into existence and beating the benchmark significantly. The other day I was looking at last 10 years of data points. Samit has, from the advisory to the portfolio management services, the overall journey, the 10 years, it has delivered more than 26% CAGR, over the period of last 10 years. So that is a remarkable achievement, Samit. So with that, I'd like to hand it over to you. Maybe if you would like to share your valuable wisdom on the topic which is given.
Yes. So I think, Vikas, really appreciate the very comprehensive, introduction. Yes, we have been in existence since 2012. And I think the topic today is more of, how do you value growth, as well as how do you, create growth through value in your wealth. And since, of course, we are growth investors, but at the heart of it, we are value investors, and as Warren Buffett says, value and growth are, part of the same equation. They are just inputs into. So it's very difficult to differentiate between sort of what is value and what is growth, because sometimes high growth companies at high valuation multiples can be really cheap, and low growth companies at low valuation multiples can be really expensive, because after all, for me, I define it this way. I find that whenever value investing is where, so if you look at investing, there are two main triggers of returns. One is after you invest, what's the earnings growth of the company, and what is the growth in the P multiple. So valuation multiple re-rating and earnings growth. Those are the two drivers of returns, right? So, for example, we have had many multi-bagger investments in the past, also many failures. But the largest multibaggers have been companies where they have delivered like 10x kind of earnings growth over a 10-year period, which is like 26% kind of earnings growth. And the same, because of the consistency of your earnings growth, the P multiples also multiplied. So the P multiples have gone up 2x or 3x, and because of which you will get a overall return of 30x. 10x from the earnings growth, and then 3x from the P multiple, right? So value investing for me is where majority of your returns are from the P multiple re-rating, where you're buying cheap, something where that, okay, it's like a cigar butt investing, where if you're buying something which is valued at 100, but you're buying it at 50, then you at a certain point in time, maybe, you'll get that 100. And that, 50 to 100 journey is mainly because of the P multiple re-rating, or, something which you got it at discount and now someone paid you fair value. That's value investing. Growth investing, or, growth and value sort of balance, is where you understand the duration or the growth much better than the market, and hence you value it differently than the market. So there could be a company which is growing its earnings at 30%, and that's what your thesis tells you, that you're growing its earnings at 30% over the next 10 years, and so it will go more than 10x in that 10 years, and you buy it at 40 times. And then at the time of exit, there is a crash and the multiples go down to say 15 times. Even if you get that kind of a huge de-rating of multiple during that time, your returns will still be more than 15%. So you probably beat the market by even buying at 40 times P multiple and exiting at 15. Because the growth is something that you understood more. So even 40 times was extremely cheap, compared to what the growth the company, was offering, right? So those are the two parameters. It's simplistically, that's what you need to understand, that when you're investing in something, what is the risk of that P multiple probably getting derated? What is the probability that maybe it will multiply? And secondly, what is your confidence in the earnings growth, right? So what I plan to do today is talk through these metrics, because see, numbers without some logic do not make sense, right? So let me put some logic into these numbers, and then maybe I'll go through two examples, the real examples which have worked for us, and some things which may not have worked for us, right? So let's start with P multiple, because growth is something that it's your estimate, it's your understanding of the business, and it's after all the expectation and your hypothesis which plays out. So I won't talk too much into the growth aspect. It's bottom up, it's individual, but multiples are something which is broad based. There is some logic to it, even though a lot of times we may think that, okay, why is some company getting 100 times multiple and some similar kind of growth company only getting 10 times multiple? There's always such a question mark. So let me throw some light, which may not answer every question, but at least it will give you directionally, how multiples get re-rated. Because once you understand the dynamics of that, you can take a much educated call on valuation, and then growth independently remains, on its own path, right? So what have been the drivers of P multiple, right? So if you just look at mathematically, if you look at two businesses, so one growing at say 25% for 5 years versus another growing at 25% for 25 years, right? So when you use a PEG ratio, P multiple divided by growth, maybe you will get the same growth for both these companies. One will get, and one company is trading at say, the 5-year growth company is trading at 20 times, and another company is trading at say 25 times. You may think, okay, the PEG ratio for the 25 multiple is high, but if you look at mathematically, and I presented in my valuation presentation, which is available on multiple platforms, is that two businesses, one growing at 25% for 5 years versus another growing for 20 years, the valuation multiple differential is 2 to 3x. That means a company which will keep on growing at a certain rate, for 20 years versus something which is growing only for 5 years and then slowing down, a 15 multiple versus a 30 multiple. Sometimes that 30 multiple can be cheaper because the difference in valuation is 2 to 3x, just because of the duration of growth. Duration of growth is extremely important in a P multiple. And hence, if you look at companies like HUL or Asian Paints, there everyone knows that the duration of growth, even if it's lower growth, is going to be extremely long. They probably will keep on growing up for 30 years or 35 years or 40 years. And hence they do get a P multiple of, that kind of high, 60,
So
70, 80.
longevity matters.
Right. Yeah, so the duration of growth is extremely important in a P multiple. And it's all about the perception of that business, of what kind of duration, that growth will last for, and extremely important. The other, even bigger factor for valuation is the discount rate. And discount rate basically is how much do you see. Discount rate is more proportionate, to the risk of the business, right? So it's I can say that it's the expected return from an investor from that business. So if you look at the overall market, if the returns of the markets on an average, say in the long run, is going to be 15%, right? That means the expected return of an investor from the market is 15%, right? So relative to that, there could be some businesses where maybe the risk of return from that business is going to be high. So for example, a lot of commodity businesses, or a lot of PSU related business, because one event can completely change the trajectory of that business. Hence, the risk associated with that business could be because of such event, or it could be risk at the margin level, it could be risk at the capex level, where the returns from or the earnings growth of that business is very unpredictable. Hence, your expected return from that business is going to be high, right? So for example, Asian Paints or HUL, the expected return from such business are lower, because the kind of investors who go in there, they know that I will not lose much capital. It's going to be, I may lose some, but I know that it will keep on growing. There's no risk that growth, or they will go into losses, or suddenly the growth will stop. So for such businesses, if the market expected return is 15%, such businesses may just demand 12% return, and the riskier business may demand 18% return. But if you put 12% against an 18% in a DCF, in a mathematical model, the P multiple for 12% discount rate comes to about 60 times, whereas the P multiple for a 18% discount rate comes to 10 times. There is a 6x differential in the multiples that one gets, just because of the perception of risk associated with that business. So it's a huge factor. So any company where that if the risk associated right now is extremely high, where that investors are expecting way higher than 15% return from this business, but 10 years down the line, once that business is big, once people change the perception that it's a very stable, consistently compounding kind of a business, the expected return from that business goes down. So something where you entered at 15 times multiple because the risk associated was much higher and the P multiple was low, but when you exit 10 years down the line, the multiple could be 40 times or 50 times. So your returns can be hugely driven by entering into business where the market perception of that business is way higher than what it is. And then over a period of time, markets realizes their mistake, that, okay, it wasn't that risky a business and it was a, stable business. And with that, P multiple re-rates, and, you get huge returns. So from a directional perspective, it's important to see what is your perception versus what is the market perception. Wherever your understanding is better than the market in terms of risk, in terms of the duration, and you enter and you turn out to be right, you get huge multi-baggers. All of the multi-baggers that we have been because of which there is a wrong perception in the market that P multiples are proportionate to the ROE or proportionate to the growth. That is maybe directionally true, but in some cases it can be exactly opposite. So ROE is something which is basically already captured in the earnings, right? So when you look at the market cap, it's earnings multiplied by the P multiple. So ROE is already captured in one metric. So P multiple, if there is a high ROE business, say 60% ROE business versus a 20% ROE business, right? But if the expected return of both those businesses are the same, say 15%, both should get the same P multiple. The market cap will be different because the earning is already high. It's already say 3x higher than the other business. So ROE doesn't make too much of a difference. Growth just because there is growth doesn't add to the P multiple. If most of the growth comes through investments. So if you put in capex for growth, because without capex you can't really create growth. You have to put up capacity. Most of the business, there are very exceptional businesses where there is negative working capital or negative investment needed. But if you are investing into new capex where the return on investment is below what is expected by the market, you can actually destroy value. So something which is valued at X and you invest into something which is extremely low in terms of return on investment, you can create growth in earnings, but you'll destroy the value of the business. So something which is valued at X can be valued at 80, 0.8X. So such things you need to be careful that just because the company is going for a capex and it's going to create growth doesn't mean it will get better valuation. Not in just terms of the P multiple, but also in terms of the overall absolute valuation. So those few things are I think extremely important to remember directionally. And then if you just evaluate any company from this perspective, you will directionally get the valuations right, as well as higher chance of you not making mistakes, right? So now let me.
Before you go to the example, I have a question if you allow me.
Yes,
So,
please.
So that is the rational logic. It should be like this. But it is not in our hand alone. It goes to investors. And at times we've seen the logic doesn't work and sometimes P multiple goes up dramatically, or at times it goes down dramatically because of the black swan event. So
Right.
What should the investor do in that case?
Yeah, so there are always going to be phases where there is euphoria in the market, right? So for example, I would say today, some of the stocks which are in the PSU basket. So for example, look at railway basket. Okay, if you look at that basket, a lot of those were trading at, whether you look at price to book of 1 times or 1.5 times, just 2.5 years back, and you look at long-term history, it was trading at that. The P multiples were also like single digit or maybe just 10-15 times. Today price to book has gone to like 10-15 times, and the P multiple also has multiplied by 5 to 6 times. And the margins today are at 12%. Historically, if you see, they have gone into losses. Sometimes they just make 1 to 3%. So there is no sustainability of margin that you can guarantee for such businesses, right? But just because now people see a lot of potential of growth, people are overpaying in terms of P multiple. And then sometimes if the stocks are illiquid, also the supply demand also creates its own euphoria in the market. So paying high P multiple at the highest margin is one of the most risky decision that you can take, because if something goes wrong and the margins don't sustain, you will take a hit on the P multiple as well as you'll take a hit on the earnings, and then it can create. And if you see those stocks historically in the last 15 years, there are at least 3 instances where they have gone down by 85%. So it's a pretty common occurrence that in a euphoria it goes up, and then during a downturn it goes down by 80-85%. I mean, if it goes down by 85%, that means to recover that you'll need to go up by 6 to 7 times. So that's the kind. So something which has already gone up by 5, 6, 7 times can easily be given up but it's very difficult for. I mean, it creates so much FOMO. The story around it gets created, so excitingly that and that's where you need to understand, does this business really deserve this kind of a multiple, and on what am I applying that multiple on, and accordingly you take a call. It's after all the risk reward that one has to look at.
Okay, yeah.
So,
So any example that
I mean,
you'd like to share before we conclude?
yes. So, I mean, just a couple of examples. For example, companies like APL Apollo or KEI Industries. If you look at what they were trading at 10 years back, their multiples were 15 times to 20 times. Both of these, or even Solar Industries, Polycap, these kind of companies. The multiples were solar was higher, but 15 to 20 times was a common multiple, which made sense at that time. Today, all of these businesses get multiple of anywhere from 50 times to 70 times, kind of a multiple, right? So, which is the multiple itself has gone up by 3 to 4x. Right? And why? Because initially 10 years back or 6, 7 years back, people thought that these are extremely commoditized businesses. Your one is like just buying some HR coil and converting that into pipes. Another one is okay, it's converting copper into cables. Right? But over a period of time, when India has gone through that 2012-13 kind of a crisis, then we had the banking crisis after 2018-19, and then COVID. They saw that these companies actually improved their profitability post COVID. They paid back the debt, they become debt free, and the margin sustained. So that completely changed the perception of these businesses. And over the last 10 years, they've consistently grown at 20% plus. I mean, historically, if you look at the growth of these companies, it's been close to 30% for the last 10 years. That means they've multiplied the earnings by more than 10 times. And it's completely just the perception change that these are companies where they have gone through multiple cycles. Their margins are not as volatile as what a pure commodity business or pure, capex kind of a business is. And these are consumables. Generally, like you will need cables everywhere, and their demand is pretty well diversified. You just don't need cables or these fabrication pipes for one industry like real estate. You need it for construction of airports, metros, data centers, factories, across real estate. So hence the demand is much more resilient. If there was a company which is only supplying to one customer like a government, and that too its use is only in one industry, which is railways, that demand, it cannot be as resilient as someone where they are getting it from 10 different industries from 100 different customers. So one needs to look at what is the risk in the growth, in the revenue, in the margins, and whether one event can completely destroy these kind of things. And it has happened across. So their multiples have gone up, and even today, I mean, there could be businesses which are considered to be completely commoditized, where the margin profile is expected to like just fall off in bad times. But if your study shows that okay, if even if the demand goes down, even if capacity utilization for these companies go down, their costs are so variable in nature that it won't take much of a impact. There are certain businesses which are capex oriented, where if their capacity utilization drops from 80 to 50, their profitability vanishes, goes down to zero. Such businesses, in a 10-year period, at least will go through two of such cycles where their capacity utilization goes down. So you'll hit, those risky periods where it can go down by, 70-80% kind of levels. So one needs to, differentiate between these.
Okay, great insights, Samit. I just one disclaimer. So the example which we've used here is only for the education purpose,
Yes.
and we're not recommending any one of you to invest in these stocks. So thank you, Samit. Great analogy, I would say. Very difficult to differentiate between value and growth, and what you rightly said. we are we are actually, all of us are value investors, but we
Right.
try to find the growth in the value.
Right.
you know
Right. Exactly, and that's the biggest problem, that everything boils down to only a one number, which is the P multiple. Everyone focuses on that one number, whereas these sort of directional, logical, factors are much more important to consider. Risk of the business is the biggest factor. Risk drives the duration of growth, as well as risk drives the discount rate from the investor, right? If you find a business which is actually not much risky at valuation which are considered to be risky, it generally turns out to be great buy, and especially if it's supported by reasonable growth, which is above market, then you have a lot of cushion. I think growth is the biggest cushion against your capital loss, and that is very important, because if you have a growth which is 20-25%, where in 3 to 4 years the earnings is going to double, even if the markets collapse and your valuation goes down by half, if the growth comes through, you'll not lose money, because the earnings will double and maybe the P multiple will half, and you'll not lose money. Whereas if you go into a value buy where there is no earnings growth, and then you buy it at X, and then during a fall it goes down to 0.5X, you lose half the money. So there is a very little cushion that one buys if there is no support of growth, and hence it's very important, the support of growth and that consistency of growth. If it's there, investors will flock into it at certain point. It may take 2 years or 3 years or 10 years, but at a certain point, they will come to buy.
all right, so with that, we'll conclude the session here. Thank you so much, Samit, once again. I appreciate that you've taken the time out and joined this session. I hope all
Thank you
our
so much,
listeners
Vikas.
have enjoyed. Thank you.